Once upon a time, in a far, far away land of Lower Manhattan, a group of brokers got together under a buttonwood tree on Wall Street, and they created what is today known as the world's largest stock market. For more than 100 years, the industry traded securities with few governing rules. It wasn't until the Great Depression that the federal government created the Securities and Exchange Commission to maintain order on the stock market. For the next several decades, the Wall Street firms mostly behaved, bringing together investors who had money and businesses and governments that needed money. Then, in 1981, almost 200 years after the Buttonwood Tree Agreement, Wall Street's first investment firm went public. It's the moment some say sent Wall Street spiraling out of control. Investment banks wanted to make more money, and they wanted to keep it for themselves. They soon realized that both derivatives and proprietary trading would do the trick. One was poorly understood but created money out of thin air, and the other allowed them to keep it. But Wall Street firms began to flirt dangerously with the thin line between investing and gambling. And as public companies, they were not only transferring the higher risk to their clients, but they were also transferring it to their shareholders, the individual investor, the retirement pension fund, the grounded mutual fund, and the wacky hedge fund. In 2008, Wall Street proved to the world and to the city it calls home that it had crossed the line. The financial crisis taught many Americans that what happens on Wall Street doesn't just stay on Wall Street. And for New Yorkers, that lesson looks a little something like this. Every year, the city collects about $60 billion in revenue. It has to collect this because that's close to the amount it spends, and because it's required by law. The city must have a balanced budget. To raise these billions of dollars, the city uses taxes, sells municipal bonds, and it asks the state and federal government for some money. But the biggest pot of gold is found on Wall Street. Investment firms, hedge funds, and the rest of the financial industry are here. The billionaires who run Wall Street are here, and a lot of the millionaires who make tons of money from it are here. This made personal income tax one of the city's biggest sources of revenue. In fact, the richest 1% of all New Yorkers make up about 30 to 40% of this. The city also collects banking taxes and other general corporation taxes from the financial industry. This adds up to a larger and larger slice of the $60 billion budget pie. Now, factor in the financial crisis and new regulation on Wall Street, and it makes for a city with new money problems. Today, under the Dodd-Frank Wall Street Reform and Consumer Protection Act, investment banks will go back to their roots. No more conflict of interest with proprietary trading, no more keeping derivatives in the dark. In other words, investment banks will act more like, well, banks and less like casinos. Many believe the result will be a rehabilitated Wall Street. And in case it relapses, this time the federal government will be watching very closely.